Our presentation tonight is Build Wealth Faster with Real Estate Investments, and we're going to be talking a lot about real estate. Here's why I'm giving the talk. I'm giving the talk because I started the White Coat Investor way back in 2011 to help doctors get out of debt and build wealth. We get all kinds of people coming by the website, 8 million annual visits. So it is the top physician personal finance and investing website. We have the top physician podcast about personal finance and investing. I'm a best-selling author. I've been investing in real estate since 2007 in one way or another. And we're going to talk about lots of different ways you can invest in real estate. And most of them I've invested in at some point or another. We have some online courses, including the No Hype Real Estate Investing course. I love real estate as an asset class. I don't like the hype around real estate, and that's why it's named the No Hype Real Estate Investing course. We'll talk a little bit more about that later. If you're here watching this presentation, you can sign up, or you are signed up to get to win one of those courses, totally free to you. Everybody who is not that does not win it, you can still buy it. There is going to be a discount offer on that for those of you attending today. More on that later, though. Okay. A few disclosures. Anytime I talk, especially to docs, but really to anybody, I think it's important to have these disclosures, have some disclaimers. The White Coat Investor is a for-profit business. Okay, most of the information we produce, 98% plus of it, including this presentation tonight, is totally free to you. But we do sell ads when you go to the website. So you'll see ads if you go there. If you buy stuff that we sell, we actually make money. We sell your eyeballs and your ears on the podcast and the video cast and, the blog. And so we actually have to make money to make payroll every month. There are 19 of us working here now. We just had our latest hire. And we are real big on disclosing our financial conflicts of interest. So I'm not going to have a lot of those tonight, but if there are any, I'll be fully disclosing them. But if you buy our stuff, we get royalties. What you need to know about me is that I am a practicing physician. I'm not an accountant, attorney, or financial advisor. So this is all for your general information and education and entertainment. Don't consider it specific financial advice in the legal meaning of that term. Okay, let's get into it now. What gets people interested in real estate investing? Well, let me ask you, are you interested in increasing your spendable income, maybe speeding your pathway to financial independence and diversifying your portfolio away from stocks and bonds? Are you willing to get a little bit more education and do some more work than might otherwise be required when it comes to your finances? And are you willing to deal with some additional hassle? And if the answer to all three of those questions is yes, then real estate may be a good fit for you. Okay. If one of those is no, you can probably turn this off right now because this may not be worth your time and effort to do in your life. Okay, here's the information about that course. You can scan the code. You can go to wcicourses.com, No Hype Real Estate Investing. That URL down at the bottom, or use the code you can scan there. Use No Hype 20 between now and November 28th, and you'll get 20% off the course. That saves you $440. Like all of our online courses, there is no risk to you, right? If you start taking it and you're like, oh, this is crappy, I don't want it, I'm not getting what I thought I was going to get out of this, you get your money back, okay, for a week. If you watch less than a quarter of it, and it's been less than a week since you bought it, we'll give you all your money back. And every now and then, somebody takes us up on one of these offers, but it's very rare because we think these online courses we put together are just packed with high yield information that you need. And the No Hype Real Estate Investing course will help you to boost returns, lower taxes, and build wealth. Okay, so let's talk about real estate. And there's really 6 good reasons to add real estate to your portfolio. Higher returns, low correlations with your stocks and bonds, some particularly inflation-resistant features, a relatively high cash flow as a percentage of your return, a little bit of an easier time adding value to your portfolio through your own effort, and some pretty serious tax advantages. I label them unfair tax advantages. They're not unfair. They're not even illegal. But it does make me wonder how many real estate investors there are in Congress every time I see how many tax advantages there are for real estate investors. Let's go through these one by one. Okay, the first one is high returns. Okay, and when you're building a portfolio, you want to include multiple high returning asset classes. Maybe you want to include some lower returning ones, but you definitely want multiple high returning asset classes. So we're talking about things like stocks, we're talking about things like real estate, we're talking about things like small businesses you control. Maybe you throw some speculative investments in there. Certainly, the last few years, precious metals like gold and silver, crypto assets like Bitcoin have had pretty awesome returns. Maybe not Bitcoin in the last month or two. I think last time I looked, it was down 29% from its peak. But my point is, real estate returns are pretty similar to stock returns, but a little bit more easily leveraged, which can give you even higher returns than you get in the stock market long term. So, one reason why people invest in real estate is because you can get high returns. And when your money is working as hard as you are and earning as high of returns as it can, you can reach your financial goals a little bit faster. Okay, the second reason to invest in real estate is low correlations with your stocks and bonds. And remember, correlations, right, are between -1, meaning something is totally negatively correlated. Every time one asset class goes up, the other one goes down, and vice versa, to +1, in which they're totally correlated and they move in sync. Zero means no correlation between the two. So if you look at long-term studies of correlations, you'll see the correlation between US stocks and international stocks is something between 0.5 and 0.94. And if you look at US stocks and US bonds, you'll see it's a whole lot closer to zero. It's about 0.1, even over long periods of time. Stocks to commodities is zero. Bonds to commodities is actually slightly negative. Okay, so that's kind of your background information. So you go, well, how does real estate do? Well, if you look at publicly traded real estate investment trusts, and compare that to stocks, the correlation between the two is about 0.45 over a relatively long period of time. That's very good. In more recent years, it's been a little bit higher than that. But 0.45 is well worth adding an asset class to your portfolio to get that sort of lower correlation. If you compare it to private real estate, the stuff that's not traded on the stock market, it's quite a bit lower. It's about 0.17. And so that low correlation coupled with high returns mean this is an awesome thing to add to your asset class, to add to your portfolio, an awesome asset class to add to your portfolio. And this is why real estate is generally the first alternative that people add to their portfolios. Okay. It also is pretty good against inflation. Inflation is one of the biggest enemies of any investor, right? I mean, the Fed is aiming for 2% inflation a year. It usually doesn't get it quite that low. And there are periods of time, like a few years ago, when inflation was running higher than 9%. Historically, there are times when it's been worse than that. Internationally, in other countries, there are times when inflation has just gone crazy. Protecting yourself from inflation really matters. When it shows up, it can devastate some asset classes like long-term nominal bonds, for instance. But real estate is a real asset. So it tends to go up in value with inflation, at least in the long term, maybe not immediately when inflation goes up, but in the long term, it tends to go up with inflation. The value of an income property, right, a rental property, is highly dependent on the rent. The more you can charge in rent for it, the more the property's worth. And as inflation rises, rents rise. Plus, most real estate investing involves a little bit of leverage, a little bit of borrowed money, right? A mortgage of some kind, other people's money, sometimes it's called. And it's simply easier to pay back fixed interest rate debt with inflated dollars, right? If you're borrowing money at 3 or 4 or 5% and inflation's running at 3 or 4 or 5 or 9%, it becomes easier every year to pay back that debt. Fixed low interest rate debt is actually a pretty darn good inflation hedge, and most real estate investors have at least some of that. Okay, the fourth reason why some people like real estate, this reason doesn't actually matter that much to me, but it does matter to lots of people. A big chunk of your return comes from income, much larger chunk than when you compare it to stocks. For instance, the U.S. total stock market index fund over the years has had a yield of like 1 to 2%. So if it's 10% return, only 1 or 2% of that comes as income. That's not a big deal with stocks because you can just sell, shares of your index fund, and you can, declare your own dividend, and the tax rate's about the same. Qualified dividends and long-term capital gains, the tax rate's about the same on that. But when it comes to real estate, it's much harder to sell a little tiny chunk of your property. And so it matters more that a bigger chunk of that return comes from income, especially if you're interested in spending that income. And you can use that income to replace your earned income during your working years, right? So it's not just during retirement years. Sometimes people want to cut back and they're like, well, how can I cut back and spend the same amount of money? Well, if you're getting income from your real estate investments, you can do that. And a bigger chunk of your return tends to come from income with real estate. So very attractive to lots of people. Okay, the fifth reason why real estate is worth adding to your portfolio is that you're very unlikely to add value to your stock portfolio. Right? No matter how much you study, no matter how good of a job you do picking stocks, it turns out that job is very difficult. It's very challenging to beat the market. It's so hard that the right answer, especially after calculating in the value of your time and the additional taxes, the right answer is usually just to buy all the stocks. But you can't do that with real estate because all real estate is local. And so in real estate, there's a lot fewer people analyzing any given property, a lot fewer people competing for any given property. And so your active management has far more potential to add value than with real estate than it does with stocks, right? You can do some of the work yourself and that boosts your returns. Yes, that's a little bit like a second job for sure. But it's a second kind of combination of a second job and an investment. And you just can't do that. You're not going to boost the returns of your Apple stock by no matter what you do, right? But you can boost the returns of your investment property. Maybe you're adding a wall in the basement and you're adding another bedroom in it or something, or you're rehabbing it, or you're doing some of the maintenance work yourself, or you're managing it yourself. Those are all ways that you can add value to your investment, something that's very challenging to do with index funds. Okay, and the sixth reason why is these unfair tax advantages I mentioned. And let's go through some of these one at a time. Okay, one is available to anybody that owns real estate. It doesn't even have to be rental real estate. It can be just your home. And if you live in a home and you live in it for a number of years and then you sell it and there's a gain on it, you actually owe capital gains taxes on that. But there is an exemption. The exemption is $250,000 if you're single or $500,000 if you're married. You can have that much of a gain and pay no capital gains taxes on that. Okay, that one doesn't matter a lot for real estate investing. But the big one when it comes to real estate investing is depreciation. And especially what you can get every few years called bonus depreciation. It's really, really generous. The general rule on housing property is that you depreciate the property over 27 and a half years. Okay. So you take the value of the building, not the land, but the building, you divide it by 27 and a half, and that's a deduction you can use every year against your real estate income from that property. And that can be a big fat deduction. Oftentimes, it will offset all of the income from the property for a number of years. So when you're investing in equity real estate, your income from this, which is already a higher percentage of the return than what you're getting from an index fund, is completely covered by depreciation. It's tax-free income. Now, it's not technically tax-free. You're technically deferring the tax, but in a lot of ways, you can avoid paying that tax ever. Okay. And even if you do sell the property and that depreciation gets recaptured, you pay it back at a maximum of 25%. So if you're in a 32 or 35 or 37% tax bracket, and then you end up paying that tax later at 25%, not only do you defer the tax and benefit from that deferral for years, but you get an arbitrage between the tax rates. Okay? And in addition to just regular depreciation, sometimes you can accelerate that depreciation via bonus depreciation or via doing a cost segregation study, because some of the things in the house don't last 27 and a half years, and the IRS lets you depreciate them even faster. It might be some furnishings, some furniture, it was particularly helpful in a short-term rental. You can depreciate it even faster. And so it's not unusual if people are taking advantage of all those ways to accelerate depreciation, that you might invest, $300,000 and turn around that same year and have $150,000 in depreciation that you can use against your passive income. So that's pretty awesome. But wait, there's more. Okay. In a couple of situations, a couple of common situations and a few uncommon ones as well. We're just going to talk about the common ones. You can use that depreciation, those passive paper losses from buying this rental property and depreciating it against your earned income, against your physician or lawyer or accountant or engineer income. And you can do that. The main way that most people know about is real estate professional status. So basically, if you're a real estate professional, you can use passive losses from your real estate investment against your earned income, which is pretty cool. So, what does it take to be a real estate professional? Well, it takes two things. One, you've got to work in real estate for at least 750 hours a year. So, that's not insignificant. That averages out to like 16 hours a week. It's a pretty significant part time job. And the second rule is that you can't spend more time than that doing anything else. So for most doctors, you're going to spend more time than that doctoring. So you're not going to qualify for real estate professional status. But many doctors, including my dear friend John, the pediatrician down the street, many doctors are married and their spouse can be the real estate professional. They file taxes, a married filing jointly return, right? And their spouse can do real estate part-time, whether that's, managing the rental properties, whether that's being a realtor, whatever, and they can then qualify for real estate professional status. And so they take their earned income and offset it with their investment losses. And so that's a pretty powerful tax tool to use. With short-term rentals, though, you don't need 750 hours. You only need 100 hours. Now, the short-term rental business is a little bit more like running a hotel business than rental apartment rental business, but it has its advantages. With only 100 hours in for the year, which is much more doable than 750, you can qualify for what's called the short-term rental loophole, and you can use those depreciation losses against your earned income. So pretty cool tricks there that are available. And I've met a number of physicians and other high income professionals that really got into real estate investing and literally paid no income taxes, at least for a few years. And you can build wealth a lot faster when that 25 or 30% of your income that's going toward taxes is now going toward your investments. So worth looking into for sure. And this is very different from your mutual funds, right? Mutual funds aren't even allowed to pass through capital losses. If you want the losses on on your mutual funds, you got to actually sell them and do tax loss harvesting and that sort of stuff. Well, you don't have to do that with depreciation losses. There are a few other really cool things you can do investing in real estate. You don't actually ever have to have your depreciation recaptured. Okay, so the very most tax efficient way to invest in real estate is to buy a property, depreciate it for a while, and then exchange it to a more expensive property via a process called a 1031 exchange. There's some rules to that, like you got to identify the new property within 60 days of selling the old one, and you got to finish the transaction within 6 months. But if you do that, that exchange allows you to not have your depreciation recaptured and not pay any capital gains on the appreciation of the old property. Okay, so it just goes into the new property, and then you depreciate that property for a few years and you exchange it to another one. You depreciate that again, and eventually you die, and your heirs get a step up in basis at death. Basically, the depreciation is never recaptured, and the capital gains are never, you never owe taxes on the capital gains. So those are pretty awesome ways to invest in real estate. It's super tax efficient. It does mean you're going to be a real estate investor until the day you die, but the tax benefits are awfully good, and you can certainly hire management out, and you can have the next generation help you manage it, whatever it takes, to be able to do that very most tax efficient way to invest in real estate. Another cool method is an opportunity zone fund, and these just got kind of a revamping in the One Big Beautiful Bill Act from this summer. And so that's a way that you can take capital gains from somewhere else and actually use them to invest in real estate in a real estate opportunity zone fund and kind of defer your capital gains and get some other capital gains benefits from doing that. The new ones are slightly different from the old ones, so it's worth diving into the details if you're interested in that method of avoiding capital gains. But the bottom line is these tax advantages are pretty significant, and one big reason why lots of people invest in real estate. Okay, so in reality, even if you just buy an index fund, you buy a total stock market index fund, you're owning some real estate. Okay, you are 3 to 4% of a total stock market index fund is invested in real estate stocks, real estate companies, real estate investment trusts. And so when we're talking about, having more than that, you're actually overweighting real estate compared to the publicly traded markets. And why might you like to do that? Well, the high returns, it's real estate, right? Maybe not higher returns than what you're getting in public real estate, but you can get high returns. You tend to get lower correlations. And perhaps once you adjust for risk, better risk adjusted returns. You may get an illiquidity bonus, particularly when you're investing on the private side and your investment's illiquid for a few years. You can get lower expenses on the private side because they're regulated under what's called Regulation D. And it's just less regulation than the stock market sees. So the compliance costs are less. And at least theoretically, those lower expenses can be passed on to the investors. Now, that also means there's fewer regulators looking at your investment. There's potential for scams and incompetence and that sort of thing. But there is potential for lower expenses there. Unlike public real estate, though, you can invest in smaller properties, right? These big publicly traded REITs, if you go buy VNQ, the Vanguard Real Estate Index ETF, you're going to get something like 120 different REITs, and each of them is going to own, hundreds or thousands of properties. When you buy that in 30 seconds at your brokerage account, you own literally thousands and thousands of properties. However, most of them are pretty big properties. It's a big, shopping mall. It's a huge apartment complexes. It's, these big industrial parks. It tends to be big properties because they got a lot of money that they need to put to work. And when you're investing on the private side, you can often get smaller properties, right? You can get single family homes. You can get duplexes and quadplexes and, 8-door apartment buildings and 30-door apartment buildings and these sorts of smaller properties that often can have better returns. Certainly, they're a less analyzed market. The other benefit is when you're investing publicly, you tend not to get depreciation passed through directly on a partnership K1. So that's another thing that people like to, take advantage of private real estate for. And depending on who you ask, in a lot of ways, private real estate has delivered better risk-adjusted returns for investors over the last 20 years. You can see using a Sharpe ratio, where it considers risk as volatility, you can see the Sharpe ratio is significantly better on the private side than it is on the public side. Okay, so why would you want to overweight real estate in your portfolio? Well, think of it this way. A total stock market index fund like Vanguard's VTI ETF contains 3 or 4% real estate, but 90% of real estate in this country by dollar value is not publicly traded. Okay, so the vast, vast majority of real estate is private. Okay, and even in that private space, investors are only purchasing like 22% of single-family homes. Most of them are owned by the people living in them, and only 3% of it is bought by large institutions. So, especially when it comes to single-family homes, it is not in the stock market. You are not getting it really in any significant way by buying a total stock market index fund. On the other hand, if you look at non-real estate businesses, there's a few thousand of them publicly traded, close to 4,000 of them in the US, but there's 27 million of them total. So that seems like, oh, you're leaving a lot of those out too. But the truth is that 21 of those 27 million are basically just a self-employed person. They've got one employee. Okay? They're not a real business. Technically they're a business, but it's not a business you can invest in, right? It's somebody's job. And so there's just far more real estate out there in terms of real estate profit that is coming from private real estate than there is profit coming from private non-real estate businesses. Because 80% of the profits from these non-real estate businesses are coming from stocks. They're coming from publicly traded businesses. So when you overweight real estate in your portfolio, that's far more representative of the real economy, the real wealth in the country. And I think you can make a pretty good case for overweighting real estate in your portfolio, even as a classic index investor. Okay, so a couple of examples of how these high returns and low correlation can be helpful to you. I want to first talk about 2022. Okay, why is 2022 significant? Well, interest rates went up about 4% in just a few months in 2022, and that can be really hard on real estate, especially if the investment has short-term debt on it, and especially if that short-term debt has a variable interest rate risk. And so when interest rates go up rapidly like that, you often see real estate fall in value. And indeed, publicly traded real estate investment trusts did fall in value in 2022. Mine lost 23% of their value. That's what VNQ went down that year. But on the private side, because a lot of that had some longer term debt or fixed rate debt or whatever, I did quite a bit better. I made almost 9% on my private equity real estate. You can see some of the investments I had there. The Origin Fund 3, which was toward the end of its life cycle, had a great year. It made 30% that year. The Income Plus Fund made 10%. The DLP Housing Fund made 19%. The MLG Fund 4 made 10%. And on the debt side, where you're loaning money to developers, I made over 9%. One of those investments was close to 12%. And so when stocks tanked that year, and they did, and when bonds had their worst year ever in 2022, my real estate was up and helped moderate my portfolio returns. I think I still had negative returns on the year because the biggest chunk of my portfolio is in stocks, and there's a good chunk in bonds as well. But it was not nearly as negative as people who had 100% of their portfolio in stocks. On the other hand, you can look at last year, right? Stocks did crazy good. They made like 25% in the US market, not quite that internationally. And real estate's returns were not quite that good, right? The public ones made 5%. My private ones, I made 7%. On the debt side, they're pretty steady Eddie kind of returns, made about 10% there, just like most years. But it wasn't the 25% the US stocks made. If you were buying Tesla and Apple and Amazon and those sorts of stocks, you probably did even better than 25%. So the point is, it diversifies your portfolio. Some years is not going to do as well as stocks, other years is going to do better than stocks, but that diversification has a real benefit to your portfolio over time. Okay, the most important aspect of real estate investing, and I cannot emphasize this enough, we emphasize this a ton in our real estate course, the No Hype Real Estate Investing course that some of you will win tonight. But the most important thing is to match the investment to you. Okay, there is a spectrum, a continuum of methods of real estate investing, and they're very active on the left side of the spectrum and very passive on the right side of the spectrum. Okay, and it's very important that you match the method to you. Going left to right, we can start with ground up construction. Right? This is when you go down to the city and you apply for permits and you buy empty land, and then you hire people or you do it yourself. You go out, dig a big hole in the ground and put in a foundation. You run utility lines in there. You build the building, then you rent it out. You put some tenants in there and you manage the tenants for a few years, and then maybe you sell the property, right? This ground up construction is very active. Okay, but there's the ability to add lots of value there if you're good at it. There's some pretty awesome tax benefits of investing on that side of the spectrum. And there's potential for very high returns. Okay? As you move left to right, maybe the next thing would be fix and flip, right? You're buying a place that's already been built, but it needs some work. So you're doing some work on it and then selling it again. Maybe the next on that would be something like short-term rentals, right? As I mentioned earlier, you're in the hotel business now. There's a lot of management you're doing. And it's potential for great returns, but again, a fair amount of hassle, fair amount of risk. Then we move on to long-term returns, long-term rentals, right? So there's people you're renting to for a year or 2 years or 3 years or whatever. So not nearly as much management as with short-term rentals. And you can even do that using a turnkey property or turnkey provider. Meaning, yes, you own the whole property, you get all the depreciation, you get all the benefits, you get to decide, when it's bought and when it's sold, and you get the final say on who the tenants are, but you don't have to do anything else, right? Maybe someone else built the property for you. somebody else put the tenant in there. Someone else is managing the tenant. If you want to sell it, somebody else will sell it for you. You're never going to get a toilet call. It's a very passive way to still directly invest in real estate. Moving on from there is a syndication or a syndicated property. And the classic example is a big apartment complex, right? You can't afford to buy it yourself. You don't have enough money. So you go in with 50 or 100 other investors, you pool your money and you buy the apartment complex. You hire somebody to manage it. And you get the economies of scale from having, instead of having a four-door quadplex, you've now got 200 doors, and so there's a lot more diversification among your tenants, and you're likely to do better. Now, obviously, you got to pay some fees to do that, and as you move left to right on this scale, you start paying more and more and more layers of fees, but it becomes very passive. You've got to do some analysis at the beginning, make sure this is a property you want to own, but at the end of the day, it's mailbox money, right? You're in the deal for whatever, 3 years or 5 years or 7 years, and all you do is you collect the checks. More likely, it just gets automatically deposited into your bank account. The downside to a syndication is you only own one property. And if you go the next step over on this continuum, you buy a private fund or a private real estate investment trust. Instead of only getting one property with your $50,000 or $100,000 investment, you might get 12 or 15 of them. And so there's a lot more diversification there, right? If one property has a bad time, you're not losing all kinds of money because that's only a tenth or 1/15 of the fund. And then finally, we get over to the publicly traded REITs, and maybe even a mutual fund that buys those for you, maybe even an index fund that buys all of them, something like VNQ. And so that's the spectrum, left to right. If you want maximum control and returns, you're going to want to be on the left side of the spectrum. If you want to minimize your hassle and maximize your liquidity, and not have to need any particular expertise when it comes to real estate, you're probably going to end up more on the right side of the scale. But I can promise you, if you invest the wrong way in real estate, you're going to be miserable. If you're somebody that's hands on and you want to know exactly what's going on with everything, you may not want a syndication or a private fund or much less a mutual fund, right? On the other hand, if you don't want anybody to bother you, you don't want any toilet calls, you don't want to have to make big decisions about it, you want lots of diversification and lots of liquidity, you're going to be very unhappy with the fix and flip real estate investment. You're going to be very unhappy running a short term rental empire. So you've got to match the investment to you. And if you're not sure how you want to invest, maybe dabble a little bit in a little bit of each of these things until you figure it out. And once you figure it out, stay in your lane and figure out and stay with the way that works for you. For Katie and I, we've had actively managed real estate investments. We much prefer being on the passive side. We prefer to invest our time actively and our money passively. And so that's why we end up mostly investing in private funds and in publicly traded REITs via the Vanguard REIT Index Fund. Okay, so if you don't enjoy real estate, you're gonna burn out pretty quickly on that direct stuff on the left side, and that's going to result in you having poor returns. So don't choose a method because it worked for somebody else or somebody else says it's the best method. Choose the method that matches you and your desires to invest in real estate, how much you want to be involved, how much liquidity you want, how much diversification you want, how much expertise you have, how much you care about the various tax benefits. That's the way you ought to choose your method. Okay. The key here is that there's no right or wrong way. Okay. It's fine to do ground up construction or fix and flips. It's fine to do syndications or private funds or just stay on the public side where you could always sell out of it any day the market's open. There is a right and a wrong way for you. And it's very important that you figure out what the right way is for you and that that's how you invest in real estate. And of course, always keep in mind real estate's not mandatory, right? Even if you just buy a total stock market index fund, you're going to have 3 or 4% of your portfolio in real estate. You don't have to, buy a syndication to be a successful investor. I know plenty of multimillionaires who are financially independent that never bought any real estate at all. But I still think it's a pretty cool asset class. And lots of people get very excited about the income from it, about the tax benefits from it, and you got to admit they're pretty cool. Okay, so how do you choose which way to invest? Well, the truth is, very few people including real estate investors, are truly passionate about providing housing for others, right? And the more you are on the left side of the spectrum, the more you have a second job, as opposed to being on the right side of the spectrum. And this is just kind of an investment for you. So you've got to ask yourself, do you want a job that you're not all that passionate about? Okay. You also should ask yourself, what are your financial goals? And can you reach them all with what I call the standard plan? Okay, here's the standard plan. The standard plan is you finish your medical school or residency or whatever the equivalent is for your profession. You go out into the workforce, you get a good job, you work hard, you try to get paid as much as you can while, being paid fairly, and you carve out 20% or more of that income and you invest it very passively into a portfolio of stock and bond index funds, and you stay the course with that for 20 or 30 years. Okay, the vast majority of high income professionals that do that are going to retire as financially independent multimillionaires. Okay, if your financial goals are more aggressive than that, you want to be financially independent earlier, you want to be wealthier than that, whatever, then you might start going, maybe I want to use a little more leverage risk. Maybe I want to get involved in real estate investing. Or I just have a goal that I want to leave a little apartment complex to each of my kids or something like that. So if you can't reach your goals with the standard plan, this is a great plan to take a look at. And keep that in mind, that the greatest tax benefits of direct real estate investing are really only available if you do it for the rest of your life in some manner. If you sell, the depreciation gets recaptured and you got to pay capital gains taxes. If you never sell, you don't have to do that and you get far more of a tax benefit. You got to ask yourself, how much work are you really going to put in? Because even if you're investing in syndications or private funds, you got to spend the time to do some due diligence. And that's far more work than it is just to go buy a bunch of index funds. So even if you're not investing directly, you're still investing passively. If you're not at the very far end of that spectrum, you may find there's still some work, and it's work you've got to be willing to do. If you don't do it, you may be very unhappy. You end up investing with, a lousy syndicator that's just their first time, and they don't know how to manage leverage, and they got way too much of it, and it's all variable interest rates, and then interest rates go up 4% in 2022, and all of a sudden they're making capital calls, or you're losing principal, right? You've got to be willing to put in the work to do due diligence. You've got to be wealthy enough that you can diversify your portfolio if you're going to invest that way. Some investments, these syndications, these private funds, require you to be an accredited investor. That means an income of at least $200,000 each of the last 2 years, or $300,000 with your spouse, or investable assets of at least $1 million. That's the legal definition. My definition is you probably ought to double those numbers and have both of them to be buying investments that require you to be an accredited investor. My definition of an accredited investor is someone who can analyze an investment without the help of an accountant, attorney, or financial advisor, and can afford to lose their entire investment without having any serious impact on your financial life. So that means if you got a $300,000 portfolio and you go put $100,000 of it into a syndicated apartment complex investment, that's probably way too much of your portfolio, right? Because that would affect your financial life if you lost a full third of your portfolio in a single investment. So you've got to solve this minimum investment diversification dilemma. And what that usually means is that means you're probably not buying, private real estate funds, um, much less syndications, until you're already pretty wealthy, until you've got $1.5 million or $2 million. That's really where it starts to make sense to deal with the tax hassles of getting another K1, to deal with this risk of having $100,000 into a single investment. You got to have a certain amount of wealth before that method really starts making a lot of sense. Okay, leverage. Let's talk about this for a few minutes. Leverage is debt, right? It's other people's money. And when you or somebody represented you, a manager of some kind, buys a property using borrowed money, you're using leverage. In the stock world, we call that investing on margin. That increases your risk, but it also increases potential returns. The way to think about leverage is that it works, but it works both ways. So if you borrow a bunch of money and you have great returns, you're going to get fantastic overall returns on the money you invested. But if you invest with a bunch of leverage and you have negative returns, they don't have to be that negative for you to lose everything. For example, if you put 20% down on a property and then it falls in value 20%, just 20%, which does happen from time to time, you've lost all of your equity. You've been completely cleaned out. So keep in mind as you're using leverage that how much you use really affects how much risk you're taking. Okay. I mentioned earlier this dilemma of the minimum investment. And when it comes to these private passive real estate investments, or even if you're investing directly, right? If you're investing in a duplex or you're investing in a single family home, you're going to need some money to put down, right? Because most of these, no down deals are just way too risky to be worth doing. So you're probably going to need $50 or $200,000 to invest directly. And some docs have this money, some don't. If you don't have the money, there are some other options. You can do house hacking. For instance, house hacking, maybe you buy a duplex and you live in half of it and you manage the other property. So you're right there. If anything happens, you can do the upgrades and the maintenance and the lawn and everything yourself and start building some equity. Okay. You can do sweat equity. When you work in the property, that saves you money you would have paid to somebody else to do that. Or you can get some partners. Maybe you're doing the work and your partner's bringing the cash. Or alternatively, you can just save up for a little while until you have the money to invest in that stuff. But passive real estate investments have minimum investments, and they range from as low as $5,000 to as much as $1 million. But really, most of them, the ones that most doctor investors are interested in, tend to have minimums between 50 and 100, maybe $250,000. But most of them are $50 to $100,000. And the truth is, the more experienced managers, the ones you want to invest with, tend to have the higher minimums. And higher minimums just make it harder to maintain diversification. For instance, if you want to invest in real estate funds and you want to have at least 3 different managers and you got to put $100,000 into each of them, but you only want 20% of your portfolio in real estate, well, that means you've got to have a portfolio that's $1.5 million, including, $300,000 that's probably not inside retirement accounts. And so that it's a higher minimum issue that makes it challenging to use those until you've already built a significant amount of wealth. And if you can find smaller minimum investments, maybe you only got to put in 10 or 20 or $25,000, you'll find it's often not worth the tax hassle, right? Because what do you get for income from that property? Well, maybe you got $1,000, and all of a sudden now you've got another K1 on your tax form. You're paying more money to have your taxes prepared, and you're going, why am I doing this for only $1,000 of income? This isn't worth it. And so it really makes sense, or doesn't make sense, until you have a certain amount of wealth and until you can really meet those typical minimum investments. Hey, I mentioned earlier the importance of being a real accredited investor. I cannot emphasize how important this is, right? Private passive real estate investing is not a game you play, 1 year, 2 years out of residency when you're still trying to get back to broke. This is a game you play a little bit down the road when you can afford to be able to lose your entire investment without it affecting your financial life. Okay. I think it's worth spending a few minutes here talking about the downsides of investing in real estate. There are lots of scammers in the real estate world. Okay. Um, Not as many as in the crypto world for sure, but there are scammers out there and you can get scammed. And this is one of the reasons why it's so important to diversify your investments so that if you lose a bunch of principal in one due to a scammer, that it doesn't clean you out. Okay. Another downside is leverage, right? I mentioned it works both ways. Real estate can also, particularly direct real estate investing, can have some aspects of a second job. And most of us have already got a pretty busy job. Tenants, right? You've got somebody living in your investment. And if you ask any direct real estate investor, particularly anybody who's managed their properties themselves for a long period of time, they will tell you the worst part is dealing with tenants. So if you don't want to deal with tenants, you probably don't belong in very many places on the left side of the real estate investing spectrum. Illiquidity can be a downside. Whether this is a direct property investment that you are, it's just hard to sell because you got to pay realtor fees and you got to pay all this kind of stuff. It takes months to sell it. or whether you're in a private passive real estate investment where your money is literally locked up for 3 to 10 years. You can have some serious liquidity issues. You cannot put money in that sort of investment that you might need in the next couple of years. This is not for money that you're going to use to pay your estimated quarterly payments on your taxes next quarter, right? It's illiquid, and that's a downside of investing in real estate. One of the worst aspects is that your taxes can get more complicated, right? If you're just investing in a bunch of index funds at Vanguard or Fidelity or whatever, you get one tax form from them, one 1099 from them, and you can actually upload it electronically into TurboTax or just hand it to your tax preparer. It's very straightforward. But once you're investing in real estate, your taxes get a lot more complicated. And this is eventually what drove me actually to hire somebody to do my taxes for me. I couldn't figure out what states I had to file in. And I've ended up filing in as many as 12 states in a given year. If you're investing directly, you're filling out Schedule E's for each of your properties. If you're investing passively, you're getting a K1 for each of these real estate investments. And when you start getting 10 or 15 or 20 or 40 K1s a year, your taxes get more complicated and you end up paying more and more to somebody else to file them for you. It's one of the downsides of real estate investing. Real estate is also local. So your rules change by jurisdiction, right? You might have all this experience investing in real estate in Denver, but now you've moved to Albuquerque or you're looking at investing in Albuquerque, totally different rules. And you've got to learn all those rules as well if you want to be successful there. There's some liability as well, particularly in the direct real estate investing space. If somebody trips and falls on your property, they can sue you. Okay. Hopefully, you put the property in an LLC, so they have to sue the LLC. And at worst, all you're going to lose is the property. But there's serious liability there. You're not going to have any liability if you're investing in index funds, right? It just doesn't exist. Now, there's ways you can manage that liability. You can put properties in LLCs, and all the private passive real estate investments are in LLCs already or in limited partnerships already. But if you're investing directly, you got to be thinking about that, and you got to buy some insurance, right? That's your first line of defense in any sort of asset protection situation. But that can be an issue when you're investing in real estate. It also requires some expertise, right? It just doesn't take that much expertise to be able to go in and purchase shares of VTI or shares of VNQ at Vanguard or Fidelity or wherever. But if you want to go buy the property down the street and you want to manage it well and you want to add value to it, it's going to take some not only work, it's going to take some expertise. And there's going to be a learning curve those first few years. So that is one of the downsides of investing in real estate is you got to spend your time on that learning curve rather than off, riding your jet ski or at work at your physician job making more money. And the other downside, of course, is that most real estate is private real estate. You can't buy an index fund of it. If you could, it'd be pretty awesome and just invest in all the property in the country, but it doesn't exist. So most of what you want to invest in when it comes to real estate, whether it's self-storage units or whether it's industrial properties or retail properties or multifamily properties or single-family homes or cell phone towers or billboards or whatever, most of it's in private hands. So you've got to deal with the downsides of investing on the private side. Okay, so how can you maximize the benefits of real estate and reduce the downsides? Well, we think one of the best ways is to take our no hype real estate investing course. And by the time you finish that course, you will have aligned your interest, your available time, your capital, and your risk tolerance with the right type of real estate investment. If nothing else, it will teach you the real estate vocabulary. You'll understand what a capitalization rate is. You'll understand what an A property and a B property and a C property is. You'll understand the differences between retail investing and industrial investing. You'll be able to more confidently vet investment opportunities that are presented by others, as well as the ones that you find yourselves. And you're going to be able to identify ways to maximize your investment returns and understand how to minimize the tax drag on those investment returns. So we think it's a great course to take. It's called No Hype Real Estate Investing. You can see it at the URLs in this presentation, or you can just go to whitecoatinvestor.com. It's not like we're hiding it. We want you to buy it, right? We make money when you buy it. Okay, you can win this course, and it looks like 3 of you have won this course. Oh, this is exciting! I just got a Slack message, and 3 of you have won the course. I think I'm supposed to announce them now. If not, somebody better stop me here, because that's what I'm going to do. Okay, here's the announcement. The first winner is Adriana Simeone. I hope I'm pronouncing that right. Second winner is Michael Foster, and the third winner is Timothy Leishman. Okay, so all of you will be getting emails here momentarily showing you how to get that course that you've won. Everybody else, I'm very sorry you did not win the course, but you can have it for 20% off. That's $440 off. Use this code NOHYPE20 by November 28th. You can use this um, uh, code, or you can use type in the URL. Either one will get you to the right place. Okay, we've got some other stuff. You don't want to buy a course, you want some free stuff we offer you. We keep a list of real estate companies. Now, these guys all pay us to introduce you to them. Okay, if they don't pay us, we don't put them on the list. But we do a relatively small amount of vetting of these companies. It's certainly not enough that you can say that's enough vetting before you invest in them. But we look at them, we're like, have they been around for a while? Is anybody saying they're running a scam or anything? And then they can be on our list. And a number of these I've invested with myself, some for many years. And so you can learn more about those. You can see that at that URL, Real Estate Investment Companies URL. Probably a better thing to do, though, and this is also totally free, is to sign up for our Real Estate Opportunities group and newsletter. Okay, and you can use that QR code there, and you'll get tips and strategies to help you maximize your real estate returns. You'll get introductions to these exclusive real estate opportunities, and sometimes these are real opportunities. You can get lower investment minimums and additional returns you wouldn't get if you went directly to these partners of ours. You'll get expert educational emails that introduce you to syndicators and fund companies and online courses and online real estate platforms. And we send that out about the middle of each month. So the regular White Coat Investor group email goes out at the first of the month. The real estate one goes out about at mid-month. So sign up for those using those URLs and those QR codes. Okay, now we're going to move into the Q&A portion of it here. If we do not get to your question tonight, you can email us at editor@whitecoatinvestor.com. You can come by the website and search for the term you're interested in. You'd be surprised how well that search bar at the upper right on the website works. You can check out the podcast and the YouTube channel, lots of real estate content on that as well. And you can ask your questions to the White Coat Investor community in any of our 4 online communities. That includes the White Coat Investor Forum, the White Coat Investors Facebook group, the White Coat Investors subreddit, and the Financially Empowered Women's group. So lots of places you can ask your questions. I think that's our last slide, isn't it? All right, let's start going through your questions. You can ask these by putting them into the comments section. I think Katie is going to help us moderate the questions tonight. So let's get to them.
Okay, first question. Have you found a good non-biased source for rating private real estate funds?
Yeah, wouldn't that be awesome that there would be a non-biased source for rating them? Well, here's the problem, right? Most of the people that could do ratings of them have a financial conflict of interest, including the White Coat Investor, right? People pay us to introduce you to them. And so, most of the places you're getting any sort of a, rating or vetting, there are at least some financial conflicts of interest. There are a couple of communities out there online that do look at these private passive real estate investments that you can join. Those communities are usually free to join. They often expect you to do a little bit of the work along the way too, if you're going to be in the community long term, and do some of the due diligence on some of these companies. But there are some out there. I wouldn't call them totally unbiased, but I'd get as much information as you can, not just what you can do yourself, but asking around on some of these communities, including the White Coat Investor communities, to get other people's experiences in investing with those folks. But there's not a morning star, like there is for mutual funds that you can use to rate all of these. You'll have to spend some work doing due diligence.
Okay, next question. Do you need an LLC for tax benefits or just liability protection?
Okay, this is one of my favorite questions. I get this all the time from doctors. Somebody tells doctors that if they'll just incorporate or just form an LLC, they're going to get all kinds of protection and tax benefits from it. Well, the truth is, lots of doctors don't get very many tax benefits at all from forming an LLC or a corporation, and they don't get a lot of protection either for their practice that they put in an LLC, because their main liability is malpractice. And malpractice is always personal, right? You can't get out of that by incorporating your practice or putting it inside an LLC. But when it comes to real estate, you can get one of those benefits. Okay, there's not really any significant additional tax benefits from putting it in an LLC, whether it's owned by an LLC or whether it's owned by you directly. The tax benefits are basically the same. You can still get depreciation. You can still do 1031 exchanges. You can still, take advantage of an opportunity zone. It's all kind of the same. But when it comes to liability protection, there is additional liability protection such that I think pretty much all of your real estate investments ought to be in a limited liability company. Okay. So if you're buying a private passive investment, right, a syndication or a private fund, it's already set up as a limited liability company or a limited partnership, which has similar protections. But if you are buying the house down the street, you should buy it via an LLC. And in most states, that doesn't cost very much. It's really not that much hassle. Here in Utah, it costs $70 to start an LLC. It costs you $15 a year to maintain it. That's it. And you fill out like one sheet of paper. It's super easy. Other states, it might cost more. I think California, it's like $800 a year. And so maybe you put 2 or 3 properties into an LLC to kind of spread that cost around a little bit. But by putting your properties in an LLC, it provides you both internal and external asset protection. Okay, by external asset protection, I mean if somebody sues you from malpractice, they can't get what's in the LLC. Now, maybe if you're the only owner of the LLC, a judge can force you to liquidate it and pull the assets out. But if there's other owners, if there's partners in there, and this benefit, this protection varies by state for sure. But if there's partners in there, usually they can't force you to take assets out of the LLC and give it to them. So that's external liability protection. It also provides internal liability protection. And this is the main reason why most investors put their direct real estate investments inside an LLC. If somebody slips and falls on the property and sues you for $1 gazillion and it's more than you have in insurance on the property, and you have to declare, and that LLC has to declare bankruptcy, well, all they get is what's in the LLC. That's the benefit. It separates, puts a wall between that property and the rest of your properties, as well as your personal assets. So yes, you might lose the property, but that's all. And so that can be a real benefit by having that. LLCs often also have some additional things they can do. For example, in some states, you're limited to a charging order against an LLC. So if the LLC doesn't distribute any income, the creditor can't get anything. And you can actually send the creditor the tax bill, even though you never sent the creditor any income from the property. And so that induces them to be a little more willing to settle than they might otherwise be. So, yes, direct real estate investments, they ought to go inside an LLC. Next question.
Okay. Most target date retirement funds include REITs. Why not just stick to these?
Okay, the vast majority of target retirement funds do not include a specific REIT allocation. They do include REITs via total stock market index fund or something like that. And that's going to give you about 3 to 4% of your investment in real estate. So it's not a lot of real estate. That's the main reason why someone would want to do additional real estate in above and beyond their index funds. Now, in our case, we put 60% of our money in stocks, 20% in bonds, and 20% in real estate. You may choose a different percentage. Maybe you only put 10% in real estate. Maybe you put 50% in real estate. Maybe you put 0 in real estate. That's a personal question. You've got to decide what you're comfortable with, what you want out of it. But that's the reason why, is because you're actually getting more of a real estate investment than what you're going to get just buying a target retirement fund. But if you're a resident and you've got $15,000 invested, there's certainly very reasonable to put your entire investment into a target retirement fund. But as you build wealth, particularly as you start having taxable investments, you start looking around and wondering what else there is. And there are some pretty cool other investments with some real benefits.
Okay. Along those lines, what percentage of your real estate investments are in debt funds?
Okay, so our real estate allocation, this is 20% of our total portfolio. And of that 20%, a quarter of it, 5%, is in publicly traded REITs, VNQ, the Vanguard Real Estate Index ETF. 5% is in debt funds. And we've got that split right now between two debt funds. We used to have three. One of them threw us out. It turned out they weren't able to take any more money that was in retirement accounts, and that's where our investment was in retirement accounts. So we just have that divided between two funds right now. And then half of our real estate investment is in private equity real estate investments, mostly funds. We have a few syndications, individual syndications left there, but mostly it's in funds. So about 5% of our total portfolio, 25% of our real estate allocation is in debt funds. And it's one of my favorite asset classes, right? It's very steady eddy. Returns are almost always between 7 and 11% a year, very little variation there. It's very easy to understand what they're doing, which is loaning money to developers. And they have, they're in first lien position, meaning if the developer defaults on the loan, they can foreclose on the property and sell it off and get the investor's principal back. And the only real downside to it, it's even more liquid than the equity side investing. You can usually get your money back within a quarter or most like a year. But the downside is it's not very tax efficient, right? All that depreciation stuff you get on the equity side, you don't get that on the debt side. You get the 199A deduction, which means about 20% of your return is not taxable, but that's not nearly as good as being able to use depreciation and being able to use 1031 exchanges and those sorts of tax benefits.
Do private funds or REITs require you to file taxes in a bunch of states?
Okay, private funds, it depends. Funds can be set up in two different ways. And in fact, one of our sponsors, MLG, offers the same fund with two different tax treatments. Okay, it offers a 1099 fund or a dividend fund. And the only tax form you get if you choose that way to invest is a 1099 once a year. You don't have to file in any other states. 1099 is super easy to get, comes early in the year. No big deal. You're used to getting them already from your taxable account at Vanguard or wherever. You can choose that option. Okay. The other type is a partnership, right? It's a K1. You get a K1 form. And that often comes with state K1s, particularly when you're starting to get income that is no longer covered by depreciation. And that might require you to file in 3 or 4 or 5 states. And that's just a cost of doing business. So you want to understand the tax consequences of any given investment before you invest in it. And they can tell you, what states they're, buying properties in. And if it's all in Texas and Nevada and Washington State, great, right? Those are all tax-free states. But if you're being invested in other states, they either have to file a consolidated return, meaning they file a return on behalf of all the investors, so you don't have to file your own personal return in that state, or they just leave it up to you, and you've got to file your own individual return there. And not all states allow these consolidated returns either. So it's very state specific, and you really need to understand it before you get into any sort of private equity real estate investment like a syndication or a fund, which is basically 10 or 15 syndications all banded together.
Am I leaving money on the table if I don't invest in real estate in some way?
Are you leaving money on the table? Possibly. Real estate tends to have returns that are pretty similar to stocks, 10%-ish a year long term. And then if you add some leverage, it tends to be a little bit higher, 11, 12, 13, 14%, something like that on the equity side. On the debt side, 7 to 11%. And so you may very well be leaving some money on the table by not getting those high returns. You're certainly losing out on the correlation benefits in your portfolio. So your overall portfolio returns may be worse. Does it matter? It may not matter that much. Lots of white coat investors retire with enough money that they don't have to optimize everything. They don't have to maximize all their returns to reach their goals. So it's okay to leave money on the table, right? You don't have to invest in real estate. This is totally optional. But I think the true answer to the question is you probably are leaving at least a little bit of money on the table by not doing this. And only you can decide how important that is to you, whether you're leaving that or not.
All right. By definition, should I own my own home before considering real estate investing?
Great question. Should you own your own home before real estate investing? Certainly, it makes the process a little easier to understand. Once you've been through a closing, you understand how a closing works. And once you've had a mortgage, you kind of understand a little better how mortgages work. And, so I think the vast majority of people probably do own their own home, their own residence before real estate investing, but it is far from mandatory. You do not have to do that. And I have run into people all the time who rent and still own real estate properties, right? Maybe it's because they live in the Bay Area, right? And it's just super expensive to buy property there. So they rent property there and they invest their money in Texas or Indiana or something. Maybe they find that returns are better somewhere else rather than the area they live in. And so they don't want to do that. Or maybe they're moving soon. Lots of different reasons why somebody might choose to rent, but that's a totally separate decision than whether you invest in real estate. What I would not do is say, I'm a real estate investor, I own my home. Your home is mostly a consumption item. Yes, it'll probably appreciate in value over the years. And yes, it pays you, saved rent as a dividend. But I would not consider that part of your investment portfolio. You add it up when you add up your net worth each year, sure. But when you add up your investable assets, don't include your home equity. Leave that out of it, because it's really not an investment. Because what are you going to do? You're going to sell it and live in a cardboard box on the street? Not really. So I would not consider your home to be, your real estate investment. But you don't have to own a home to buy one. Lots of people don't. But I would say the vast majority buys their own home, kind of gets that under control, and learns to understand the process and how to maintain and manage a home before they start buying rental properties. But some people start doing it really early. You run into college students or medical students every now and then who get into hacking. Usually with their parents' help, they buy a house and they rent out 3 of the bedrooms to their classmates. And, maybe they end up living rent free while they're in medical school. And if it appreciates a bunch and the mortgage is paid down some, maybe they actually come out of that with some money. There's obviously a lot of risk there. And it's good to have some parents backing you up when you're doing that sort of thing. But you can do house hacking later on as well, during residency or after residency. You can buy a duplex, you can live in half of it for a while. And then when you move into your doctor home, you can rent out both halves of it. And maybe that's your first real estate investment property. Lots of ways you can do it. But for the most part, most people probably are buying the house they live in first.
Okay, can you address owning these assets inside of an IRA or 401k versus non-sheltered accounts?
Okay. So you can put real estate investments, private investments, inside retirement accounts, but you probably can't put it in the 401k you're being offered by your employer. You can check. Some of them have a brokerage window and you can buy anything that's available at the brokerage. And sometimes some of the investments are available at the brokerage, but for the most part, you're not going to be able to do it in the 403b you're getting from the university hospital. So it has to be some sort of a self-directed account. Now, that might be an IRA, and you can move your IRA to a provider that offers a self-directed investments, right? It's a little harder to do that at a Vanguard or a Fidelity or a place like that, but there's lots of IRA providers that offer this option. We've got a list of them under retirement accounts, under our recommended tab at whitecoatinvestor.com. An even better way, if you've got control over it, is a self-directed 401k, right? This is usually a solo 401k, meaning you've got some 1099 income, you're self-employed in some way, because you can put so much more money in a 401k each year. This year, you could, if you're under 50, you could put $70,000 if you earned enough into a solo 401k. And if it's a self-directed 401k, that can all be invested into private real estate. And so that can give you some additional tax sheltering there. But after doing this for the last close to 20 years, here's my advice about using retirement accounts for real estate. It's great for debt real estate because debt real estate is so tax inefficient. Getting that inside retirement accounts really boosts your returns in a big way. That's worth the hassle to do that. And those tend to be more liquid investments anyway. It's probably not worth the hassle for private equity real estate. I think you're probably a lot better off putting that in your taxable account. And most people who are making enough money and have enough money that they're, looking at these private passive real estate investments like syndications and private funds, they're going to have a taxable account too. They're not going to have all of their money in 401ks and Roth IRAs. The other thing that you can do for real estate inside a tax protected account, a retirement account, is just VNQ, right? It's the Vanguard REIT index fund or a similar, REIT index fund or REIT mutual fund. That's pretty easy to put inside a lot of retirement accounts. It's often offered in your plan at work or through a brokerage window. It's really easy to buy at the brokerage. And it's easy to put inside an IRA as well. So that's real estate that's easily put into a retirement account. Debt funds are a little bit harder, but if you have a self-directed one, it's probably worth the hassle to do. I don't think I'd bother for private equity real estate investments, though.
Can you benefit from bonus depreciation to offset your W-2 income in syndications and private real estate funds? And does this require reps?
Okay. Well, if you want to use depreciation and bonus depreciation against your earned income, against your W 2 income, you've got to qualify to do that. And that typically means either acquiring real estate professional status or going through the short term rental loophole. Now, that's pretty much incompatible with investing passively. Okay. For a couple of reasons. One, it's very hard to do it, to just fill out the tax forms and do it. But two, if you're investing passively, you're probably not putting in the hours required, right? Real estate professional status is 750 hours. So that probably requires some direct real estate investing to be able to get to that. And it's probably not just one property either. If you're going to try to convince the IRS you put in 16 hours a week managing the single family home down the street, they're probably going to call BS in an audit, right? So if you've got a whole bunch of direct real estate and you've got some private passive real estate that's passing through depreciation, and you're qualifying for real estate professional status based on your direct investments, then you can probably use some of that those passive losses coming from the syndications. But I just think that's a pretty rare person. If the idea is I'm going to buy some syndications so I can offset my earned income, that's probably not going to work most of the time.
Okay, last question. If you're going to invest in REITs, where is the best place to purchase those funds? A 401k, taxable account, Roth, HSA?
Okay, this is the wrong way to ask an asset location question, okay? Because that's what we're talking about, is what goes in taxable, what goes in Roth, what goes in tax deferred, et cetera. The right way to ask that question is what goes into taxable next of the investments I own, of the investments I want in my portfolio, of my asset allocation, what goes into taxable next, okay? Rather than where do I put this, okay? So when I look at all the things we own, total stock market index fund, a total international stock market index fund, bonds, and in taxable, it's usually via a muni bond fund. That's the sort of stuff I put in taxable before I would put in, VNQ or a Vanguard Real Estate Investment Trust Index Fund. So it's a relatively tax inefficient asset class. So it's usually one of the later things you move into taxable, kind of like tips. Tips are not awesome in taxable either. So they tend to be one of the things people move later. But once you've got all your stocks out of there, it's something to consider moving into taxable. But for the most part, our portfolio is like less than 20% tax protected now. And we've still got all our REITs in those retirement accounts. So it's one of the last things you tend to move out. So the easy answer to your question is put them in retirement accounts. That's our last question. All right, I guess we're going to wrap up tonight. I hope you enjoyed this presentation. If you're interested in learning more, check out the course. There's no risk. We'll literally give you your money back. If you send us an email in 2 days and say, you know what, this really isn't for me, we'll send you your money back. Okay. Sign up for the real estate newsletter. Sign up for the and check out the real estate list that we have there of these partners we have. A lot of them we've had for a long time. They've had lots of white coat investors invest with them. I think DLP told me the last time I talked with them, something like 25 or 30% of their investors are white coat investors. You've got a lot of peers investing with these companies, earning great returns, very happy with what they're getting, investing more money each year. And so check out that list if you're interested in private passive real estate investments. We also have a turnkey provider on there. We have at least one syndicator on there if you're interested in having a little bit more control over the investments that you're invested in rather than turning it over to a fund manager. Lots of different options there. And of course, you can always go out and buy the single family home down the street and rent that out. Lots of different options for investing in real estate. Hope this has been helpful to you. If we didn't get to your question tonight, you can email me, editor@whitecoatinvestor.com, or better yet, ask your question on the forum or Facebook group or the subreddit, and you'll be able to crowdsource the answers to that question. Thank you for your attention tonight, and I hope you all have a great evening. This was great. This is like the best part of my day so far. Hopefully my hockey game tonight goes even better and my team wins. I'll see you next time we do one of these. Thanks for your coming tonight.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.